Good afternoon, everyone. Welcome to the Shearman Sterling webinar, Project Bonds Continuing the Trend in 2013. As many of us have seen, project bonds, private placements have really become a useful tool and a significantly growing area. So we thought that it would be valuable to our clients to discuss the current trends, walk through the basics of private placements and project bonds in this type of setting. I'm Rob Freedman. I'm a partner in the project finance practice of Shearman Sterling's New York office. I also co-head the firm's Sustainable Development Group with my partner Patricia G here. And together with my co-presenters, my partners Bob Treuhold, Don Lonsack, and Tricia Hamas, we've all been involved in both the project bond, the 144A transactions, and recent 4.2 private placements. So by quick way of introduction, I'm joined this afternoon by Bob Treuhold, who's a partner in our New York capital markets practice, Tricia Hamas, who's a partner in our New York project finance practice, and as I mentioned before, co-head with me of our sustainable development practice, and Don Lonsack, who's a partner in our tax group. So throughout the presentation, you should feel free to submit questions. There should be a Q&A box on your screen. We'll try to answer as many of them as possible. If your question's not answered during the session, we may get to some of the questions during the session. We'll see kind of how it goes with the flow of the presentation, or we may get to them at the end. If we don't get to your questions by the end of the presentation, you really should feel free to reach out to any of the four of us after the presentation. Our details are specified in the back. For those lawyers on the phone, the program's been approved for CLE credit. Participants who are experienced lawyers are eligible to receive approximately 1.5 New York professional practice credits or 1.5 California general credits. To complete the credit requirements, you should download, complete, and submit to us the sign-in, sign-out sheet and the evaluation form, both of which can be found in the CLE requirements box on your screen. Finally, all the materials that are part of the presentation today can be found in the folder entitled Presentation Materials at the bottom of your screen. So that completes the introductory remarks. With that, I'm going to turn it over to my partner, Bob Treuhold.
Thank you, Rob, and thank you, everybody, for joining us today. I'll jump right in and talk a little bit at the outset about the different types of securities offerings that are used in the project bond context. The reason we start with this is one of the principal differences in project bonds from a traditional project financing or bank financing is that it involves the offering or issuance of a security. Really, the bottom line why that matters in a U.S. context is the securities laws become applicable, which are not really of direct relevance in the context of a traditional project financing. The starting point would be, and the starting point of the U.S. securities laws are that any offering of securities must be registered with the Securities Exchange Commission, the SEC, unless an exemption is available. So a public offering would entail registering a prospectus, a registration statement with the SEC, and if you do so, that offering can be extended to anyone, retail, anybody, anywhere, and pretty much any time, and not limited to so-called qualified institutional buyers or accredited investors, the type of institutional investors that we're more familiar in dealing with. As I said, in order to avail oneself of a public registered offering, it's a fairly cumbersome process because the SEC has very strict rules mandating the level of disclosure, mandating the nature of the audited financial statements that need to be included in the document. And frankly, as a result, relatively few project bonds that we see are, in fact, registered with the SEC. There is the ability for seasoned issuers, for issuers that are already public companies, to put up what's called a shelf registration statement. That enables them to pre-register securities. And if that's available to the issuer in question, that does speed the process. If that is not available, the process can take some time. Another concern relates to public disclosures, something called Regulation FD, or Fair Disclosure, which basically mandates an equal playing field so that all investors have access to the same information. That rule is generally not applicable in the context of a public offering. Basically, I will move on from now to the 144A market, which is frankly of more direct applicability or relevance in the context of project bonds. What 144A is it's been around for over 20 years. It's an exemption from the registration requirements to permit offerings to a defined class of investors who are known as qualified institutional buyers, QIBs. What QIBs are institutional buyers who have own or invest on a discretionary basis over $100 million in securities. This is very commonly known to the banking community. They have lists of QIBs, and the benefit is that you can offer to those QIBs without a need to register with the SEC or comply with all of the SEC's disclosure requirements. Very often, Rule 144A offerings are combined with so-called Regulation S offerings. These are offerings that are made to non-U.S. persons outside of the United States. It's a jurisdictional line, which basically the SEC acknowledged that if an offering is done offshore and to non-U.S. persons, you don't need to register with the SEC. While there's no SEC review, and as a result there are no specifically required disclosure standards or requirements, market practice has evolved such that basically a prospectus for a Rule 144A placement looks and smells very much like a public offering document. There may not be the same level of financial information. There may not be all of the bells and whistles you would see in a registered public offering, but it's very similar. In the context of a Rule 144A offering, however, it is a private placement, and as a result, there are restrictions that need to be complied with respect to public statements. Traditionally, there can be no advertising or general solicitation. I'll come back and say a word on that in a second. The other principal type of private placement that you hear spoken, and Rob mentioned this in his introductory remarks, is a 4-2 private placement. Again, it's a transaction by an issuer that does not involve a public offering. It does not require, as a result, registration with the SEC. And the 5 traditional criteria for a private placement focus on the nature of the offerees, the investors, and traditionally those are limited to accredited investors or sophisticated investors, basically professionals or individuals who have the financial resources and degree of sophistication to bear the risk of a private investment without the protection of the SEC. Usually there's a limited number of offerees. There's no general solicitation or advertisement concerning the placement. However, as you may have read, the SEC has recently proposed a new rule to permit general solicitation in connection with certain private placements. This was mandated by the Jobs Act, which has received a lot of press. That's not the subject of today's discussion. So far, since those rules are not yet adopted and we're not really clear how they're going to pan out, so the rule remains for the time being that no general solicitation or advertising would be available in the context of a private placement. In a private placement, the potential investors are given access to information. They're given an opportunity to do their own due diligence. And as with any private placement, the securities that are so placed are subject to resale restrictions.
And I think, Bob, just to add a little bit of a practical element, which we'll try to introduce throughout the presentation, when folks first kick off a transaction that involves either 144A or 4.2, it's not uncommon for folks to just refer to either as a project bond transaction. But there is, and this is what we'll show throughout the presentation, there really are differences between the two, including just how you process the transaction. So it really is important up front when folks are using the term project bond that you really get a good understanding and have an agreement up front as to which market you're really targeting, whether it's 4.2 or whether it's 144A, because that will affect your transaction process as well.
We wanted to spend some time talking about the disclosure standards. As I said a minute ago, even in a private placement, the practice has evolved to provide in an offering document fairly full disclosure, and that starts, of course, with a description of the project. Before going into detail, but to go to Rob's point, in a 4.2 private placement, since very often you're focusing on a smaller number of investors, generally those investors are provided their own opportunity to due diligence. Very often you will have a thinner offering document. Sometimes there may not actually be an offering document in certain 4.2 private placements. So it is very important at the outset in kicking off a deal to determine what your audience is. If the decision is taken to go to a full 144A offering to qualified institutional buyers, the expectation would be to have a fully vetted and complete offering document.
And part of the reason for that really is also that the difference of who's doing the diligence process, right? With a 144A, the investors are really not going to be doing too much independent due diligence. They're going to be relying on the offering memorandum and the rating agency review and all of that.
The underwriters.
Right, and the underwriters. Whereas with the 4.2, each of the investors with private placement, each of the investors is really going to be doing a lot more hands-on diligence, generally speaking.
Again, coming to what you would see in an offering document, you would need to include, and this is fairly obvious, a description of the project, the goals, the sponsors, the history of the project, the construction process, a summary of all of the relevant key contracts and contractors, and basically the business model, the proposed revenue structure. One of the most important sections, and the one that takes a lot of time, are the risk factors relating to the project, to the country, to the nature of the security. These are indispensable. They're not only useful to point out the risks to the investors, but they provide effectively an insurance to the issuer and to the banks and underwriters and offering participants against attack either from the SEC or in the context of future litigation. If you correctly and specifically pointed out the risks to an investor, and the investor is a sophisticated investor, it becomes more difficult for that investor to subsequently try to seek damages if, unfortunately, a project goes south.
Bob, just backing up, and it's kind of related to this, but it also goes to the first point, and here I'm going to throw you the curveball question that you're not prepared for, but hopefully you'll be able to address. I think, when you're doing a project deal, as we all know, the nature of it is that it's supposed to be a non-recourse or limited recourse financing. So when we're talking about disclosure on the sponsor level, there tends to be, I think, a fair amount of sensitivity as to what degree of disclosure would be required. And I was wondering if you could maybe address that briefly, because I would guess that would be an issue that our audience might struggle with from time to time.
Thank you, Tricia, because it is a very sensitive issue, and frankly, at times may determine at the outset whether or not the project is an appropriate one for a project bond financing, at least to the 144A market. Because depending on the nature of the sponsors, obviously it becomes much more easy if the sponsor is a public multinational company with available public disclosure, then it's less of an issue because you have lots of information available. If, however, the sponsor is not known or does not want to be known, and consequently one is unable to provide the necessary level of disclosure to the investors, that may well be a situation where it's more appropriate to access the traditional bank financing model for a project. It's one of those issues that needs to be vetted at the outset of a transaction, discussed and explored. In the 144A market, traditionally the underwriters, since they bear a fair amount of responsibility for the prospectus and the investors are looking to that, lawyers get involved, other external experts such as the engineers get involved, and they may or may not be able to give the necessary opinions and support to permit access to the 144A market.
Yeah, and to that point, Bob, and to Tricia's point, it is a gating item when you're deciding which transaction to go with, either the 144A or 42. A gating item might be whether you can really prepare a satisfactory offering circular or not, and that may be because the off-taker involved in the deal, you can't get financials on, or they're a material part that has to be disclosed, but you can't get proper disclosure on them. But those items really, as a deal process point of view, should be vetted up front. Otherwise, you may get to the point of going down a route and then you're in the middle of preparing the offering circular, realizing that you can't fit a fundamental piece into it.
And one of the key points of fitting into this are the projections on a project. In a traditional bond offering, when I say traditional, I'm talking about a straight investment grade offering for a public company, one would traditionally not include projections because you're talking about an established company, and frankly, they don't really want to be out on record providing forward-looking detailed projections of what they will or will not do in the future. That's unrealistic, frankly, in a project context where you're starting up a project and an investor's not going to put down his or her money or its money until knowing what the business model is. So including construction cost estimates, the timeline for construction, demand volumes, revenues, expenses, all of those details are going to be a necessary part of the business model that will be part of the engineer's report and would be included in a prospectus for a project bond offering.
Yeah, I think that's one of the points where there's a big difference between a project bond and other types of security deals you would be doing. And I actually had the issue specifically come up yesterday with somebody who's relatively unsophisticated in the area who said, well, of course we're not going to provide projections. And I was like, good luck getting your deal done.
Right. No, I think you're going to need it. And as a result, again, that may be a situation depending on the nature or riskiness of the project and also the stage of the project. Sometimes projects that are greenfield or startup construction projects may not be ripe to layer in a project bond at the outset. You may start the project with more traditional bank financing, project financing, and then as a second step, when construction is either complete or substantially complete, at that point there's fewer risks. The projections may be less uncertain, and at which point you may be able to have an offering document on which the offering participants are more comfortable.
Well, I think that's a good point. Just going back again to how you decide what kind of financing you're pursuing is that very fact. You see 144A is much less in a construction financing, partly because of the negative carry issue as well, right? The private placement market, I think, is moving to being able to do kind of limited multiple draws. So that's being used in kind of the hybrid structures we're starting to see develop, particularly in the renewable energy sector, where that can be a tranche of debt that's longer dated than maybe some of the commercial bank debt.
So again, tied into the same issue is that one would need sources, backup, for the disclosure and the projections included in an offering document, and that brings in the third-party consultants, the lawyers, the engineers, the accountants, because bottom line is one needs to have comfort, is the general word that one uses, on the information, both financial and other, that one includes in an offering document. Again, it would be expected, or not expected, it would be required to have audited financial statements in the project to the extent they are available. Again, tying into the same issue, if the startup there's no record, it may be harder to access the 144A market. Again, other things, these are obvious to the extent there is a concession or other local laws applicable wherever the project's located. You're going to need to describe the concession goal. You're going to need to describe the compensation structure, as well as the term and length of time of the applicable concession. That could obviously have an influence on the tenor of the notes that you're hoping to offer. We've mentioned the independent engineer's report.
Yeah, and that one I would just add, as we've discussed among ourselves. I mean, the independent engineers report and other consultants' reports are, kind of a fundamental of all project finance deals. But all of us have had experiences, even in bank deals, where negotiating the engagement letter and reliance provisions are time-consuming, and there's a lot of back and forth with the engineer under which circumstances with who the report can be shared. That just is heightened in a project bond context, and it's something that needs to be addressed up front. And you want to make sure that whatever, i.e., if you're a sponsor, you're hiring to kind of do the initial legwork before you get down too far into the financing, is aware that this may be used in the securities context, because I think that there are consultants out there that have gotten to the point where they have the right engagement letter, the right provisions, that they're willing to go that route. There are others that aren't, and then there's ones that are in the middle, so there can be a lot of back and forth on that, and that's something obviously that the lawyers generally handle, but it's frustrating to everybody when a deal gets held up because of the consultants.
And similar issue with respect to accountants. I worked on one transaction where they had planned to access the project bond market, but the accountants were not, frankly, acceptable to the underwriters, and they had to go back and get a different auditing firm in order to come up with audited financials that would be acceptable to the market. There's also a market report that is not always included, depends on the nature of the project, but same type of context.
Yeah, and the financial statements, just one more practice tip, the financial statements can affect also the timing of a transaction, depending on when they go through, whether they become stale or not. So you have to focus also on the financial statement disclosure for purposes of when you can launch the transaction as well.
The other key part of an offering document, whatever the nature of the offering, and this is again fairly obvious, is the description of notes, or the structure of the notes. And very often you'll see that handled separately from the disclosure about the project. You'll have a separate team that's working on the notes themselves. And the key document, at least in the U.S. market with respect to any form of bond offering, is a contract that's called an indenture. This is a contract between the lender and issuer, setting forth the terms for repayment, the time period, the interest rate, and the terms relating to whether the bond is callable. It's where you would have negative pledge, the fundamental covenants setting forth the terms of the document, whether additional debt issuances are available. The practice of having an indenture in all bond offerings goes back to something called the Trust Indenture Act, which was enacted in 1939 to regulate the bond market and to ensure that investors were protected by a standard contract that had provisions. The Trust Indenture Act itself is only relevant and applicable in the context of registered offerings, SEC registered offerings. However, the practice is effectively to follow an indenture that looks and smells very much like a public indenture, and it's a standardization that makes access to the bond market easier. It's kind of almost a check-the-box type exercise. Other key contract that's very applicable and relevant in the context of project bonds or projects in general, obviously those of you in this field know this, it's the intercreditor arrangements. This is the agreement between two or more creditors of the same borrower, establishing the relative rights between different classes of creditors, priorities of payments, waterfalls, and things of that nature. I'll let Tricia speak to this a little bit later, but the issues in the context of a project bond it's not dissimilar to having different layers of mezzanine financing or whatever. The benefit of accessing the bond market is that, bottom line is, you try to design it so that you don't need to go to the bondholders to get consents the way you would traditionally in a bank market. You try to limit the project-specific undertakings, the covenants, or the events of default such that the bond basically stays out there unless there's a major event of default. Obviously, negotiating with a large number of bondholders would be much more difficult than with a smaller number of banks. So this is yet another reason why very often you don't access or don't try to access the bond market during the sensitive construction or the critical construction phase, because that's when you are more likely to have delays, more likely to have events that could have a direct impact on the project.
But again, that's also a difference between a 144A and a private placement.
Sure.
It's all degrees, right? On the scale of commercial bank financing, private placement, 144A kind of traded bond. That you have to kind of weigh the pros and cons of where you want to be, given where you are in the life of your project.
Sure. The trustee, just a word, under an indenture in the context of a bond offering, you will have a trustee. But it's important to understand that the trustee is not really the same as the agent bank in a bank financing. The trustee is really just a representative for the bondholder, but doesn't take independent decisions. And so there's a slight difference in the nature and role of the trustee.
I agree with that, although I closed a private placement at the end of last year where we actually had to kind of negotiate with the trustee agent to take on a little bit more than they normally would have because of the nature of it being a private placement, and there was no kind of agent for the insurance company investors in that deal, and there were certain things under some of the documentations where things had to be processed, and it wasn't really feasible to go back in the ordinary course necessarily to all of the investors, and so they had to exercise a little bit more discretion than the big players out there like the Bonies of the world customarily want to do. So we had some back and forth on that, saying in this particular instance, part of the bidding for this role was that you were going to have to take on a little bit more responsibility than you normally would want to.
And I think you could see that in the 4-2 context, in the private placement context, where the investors expect to be more involved in the process going forward and therefore might need somebody who is more active. In the 144A context, the bondholders expect to be passive, and therefore, I think you'd be less likely to see that situation there where a trustee would become more active just because the bondholders expect to be passive in that case.
Rob, you want to take it from here?
Sure. Yeah, I'll go back to just to spend a couple more minutes on the stuff that or the items that Bob had touched on, raise a couple more points, and then one or two practice tips. The items that were not in the presentation, but I think which are important noting, is also rating agency requirements at the outset between a 144A and a 4-2 transaction. Rating agency ratings are required in our experience in both situations. The requirements may be more strict in the 144A context than they are in the 4-2 context. You may need a Standard & Poor's and a Moody's and or a Fitch in the 144A context. In the 4-2 context, you may get away with having only one or maybe having Fitch, S&P, or Moody's in that context. That factors into the transaction as well because each rating agency may have different requirements. Some rating agencies have very strict requirements for project finance transactions around what's referred to as ring fencing or bankruptcy remoteness. In those contexts, then you need to be prepared if a rating agency has a strict requirement around that. You need to make sure early on that your transaction is set up to address if there's a substantive consolidation opinion that's required, if there are other ring fencing requirements. And ring fencing refers to basically having the project company that owns the asset as an entity which is bankruptcy remote from its sponsors or parents. So knowing which rating agency you're going to is an important part.
I would add to that I think that the substantive consolidation issue is getting increasingly heightened even with all three of the rating agencies.
Yeah.
mean, again, one of the deals I closed at the end of last year, the counsel for the sponsor had not in the past ever been asked for that in similar structured deals and was surprised by the request. They ultimately could give it. It wasn't an issue. The deal had been structured properly. But I think in that case, the rating agency that was involved hadn't in the past really insisted on it, but was moving more in that direction again. So
yeah, and you may run into sponsors.
You should assume up front you're going to need it, and if you don't, that's great.
Yeah.
It's great for the law firm that doesn't have to issue the opinion at the end of the day. But I think it's best practice to assume that it's going to be required.
Yeah, because it would not be unusual to run into a sponsor that has owned, let's say they were looking to use the access to 144A market to refinance a project that they had owned for some time, and frankly they had been lax in terms of their corporate controls. They hadn't kept separate books and records. They hadn't, sort of operated the project on a separate, real standalone basis. If you're not flushing those issues out up front, when you get to the point that you're really meeting the rating agency requirements, those issues then start to surface.
Well, and I think we've even been involved, as I recall, in one transaction where after closing, we had to go back and amend constituent documents to meet certain rating agency requirements that they hadn't really focused on before giving their rating. So it is something you want to be proactive about and not have come up at the last minute, because it can cause a lot of scrambling.
Yeah. No, and luckily in that situation we were in the safe zone. So, but and then the last point is, again, as a practice tip, the relevance of the disclosure document in a 4-2, let's say, or in a bank transaction. The lenders or the investors would expect their counsel to prepare a diligence report, and so a lot of the process in the beginning of the deal is the preparation of a diligence report by lender's counsel or issuer's counsel in the case of the 4-2 transaction. In a 144A transaction, your disclosure document should be your diligence report. If it was material to the interest of an investor, then it should have been included in the offering document. So it serves that purpose of a diligence memo in a sense as well. So to now move on to a little bit more of the commercial terms of these transactions and to show you a little bit more of the differences between banks and private placements versus 144A, we came up with a bit of a matrix. And the reason we put together banks and private placements is the transactions do look similar in a sense that there are investors or lenders at the table during the execution phase. So if you're an attorney, your clients are sitting at the table during the execution stage, whereas in a 144A transaction, your clients are the underwriters or the placement agents, and your goal in that transaction is to represent them in placing the bonds. You do not represent, in that case, all of the bondholders, and your interest is in ensuring that the transaction has been executed for the underwriters, the disclosure has been proper, but you're representing the underwriters who in most cases will be not associated with the transaction after the transaction closes. So that factors into, again, your transaction process, and it factors into the terms of the transaction. So a good example to start with is representations and warranties. I won't get into the very basics of what they are, but we all know that these are risk-sharing provisions where you undertake diligence relating to a project. In the bank and private placement context, these diligence statements or risk-sharing provisions are included in the document directly with the long-term investors. So you'll find them in the credit agreement. You'll find them in the note purchase agreement with respect to a 4-2 private placement. There is sometimes a bit of misunderstanding as to the role that they play, however, in a 144A transaction and where you should find them in a 144A transaction. And Bob and I have been involved in transactions where we sort of had to walk through the process of kind of where you find reps and warranties in a 144A transaction, where the purpose in that transaction is to establish the diligence defense for the underwriter. So what you find is the representations and warranties will be included in the underwriting agreement and run to the benefit of the underwriters. They are not typically included in an indenture running to the long-term benefit of the bondholders, because the bondholders' protection for those items that would have otherwise been disclosed in a credit agreement or a no purchase agreement is the offering circular. Again, the offering circular being the document where if it was material, it should have been disclosed in the offering circular. So even fundamental items of, you would have a representation and warranty in a credit agreement or note purchase agreement as to environmental hazards that may be at the project. And the lenders take comfort from the fact that the project company is representing as to any environmental hazards at the project. In the 144A context, if there was an environmental hazard that was material to the project, then it would have or should have shown up in the offering circular. So that's the difference. The substance of the representations and warranties tends to be very similar between transactions. You're going to find the standard representations and warranties as to authorization, execution, enforceability. You'll find the standard project-related representations and warranties. It is, and it may sometimes be the case, that representations and warranties that run to the underwriters in an underwriting agreement, if you're doing a transaction that has both a bank piece and a bond piece, it may be the case that the representations and warranties are different. And we've been in situations where if we've been on the underwriter or lender side, a sponsor has said, well, I really want to make sure that my representations conform. I'm giving this rep to the banks. I don't want to give this rep to the underwriters. Sometimes that may be a very fair and valid point. There may be particular circumstances, though, where it is appropriate that the two representations and warranties or a similar representation and warranty covering similar substance is worded differently. Next, we get to the covenants, and this goes, the design of the covenants between the two types of transactions goes to a point that Bob had raised earlier, which is the design of a 144A transaction, the expectation, I should say, of 144A investors, which is they are interested in getting paid principal and interest. They're not interested in actively managing an asset. And in large part, they're not set up to actively manage assets in the same way that a bank may, or that an insurance company or a private placement investor may have the ability to more actively monitor an asset. So really, the obligation of the deal team is, and we often say this when we're on the underwriter side, is that what it really is about, and this is frankly why doing a 144A transaction is enjoyable, because it's everybody around the table should be working towards the same goal, which is placement of the securities, proper disclosure, and creating a transaction that works for the sponsor going forward. And a transaction that works for the sponsor is one that's flexible enough such that really during the life of the transaction, they really should never have to go back to the bondholders, because doing so is a very difficult process. So it's also why, to the point that Tricia had raised before, you see the 144A transaction typically not used for construction, although there are some examples of that, but you would typically see a bank piece for construction, and sometimes, and more often the case now, we're seeing it in the renewable sector, you'd see a 4-2 piece for a construction process. That is related to two primary points. One is economics, and the other is terms. The economic point is what Tricia had raised regarding negative carry, which is bondholders don't typically, and again, we can all, I'm sure, find an exception to the rule, so I won't use the word always, but in general, bondholders don't prefer funding construction over periods of time. Instead, the requirement would be that they fund the entire process up front. As many know, in a construction process, though, you don't pay your entire amount of proceeds to a contractor on day one. You may pay it out over a 2-year period. So the difference between the amount that you are paying in interest on the full draw that you brought in on the bonds on day one versus the amount of interest that you're earning in that account is what folks refer to as the negative carry issue. The private placement market recently has become more flexible, and I say recently, but it was a trend, frankly, that private placement investors did historically as well. It had been around, including in the 90s, and then it had sort of gone away for a little while, and then it's back now with the institutional market being willing to fund construction, and economically they deal with the negative carry issue by funding into a collateral account on set dates and then drawing amounts from that collateral account subject to construction requirements. So those are the economic reasons why you might not see a 144A transaction during construction. The next is the process issues, which goes to the issue of the covenants. So covenants, as you can see in a bank and private placement transaction, are designed to be a bit more restrictive, a bit more controlling on the sponsor than in the 144A transaction. So, for example, we don't have the construction process up there as an example, but change orders, it's not unusual in a bank transaction or in a private placement if you have a significant or material change order under your construction process, you typically need to go out to some amount of the investors to get approval for that. That wouldn't work in the bank, in the 144A context. You can't always go out to the investors to manage that process. So if you were doing a construction process, it very often might rely on the independent engineer to make a determination. But once you're through the construction process during the term, other examples would include, as many of you may be familiar in the bank market or private placement market, the permitted indebtedness provision is very limited. You might have some limited amount for capital leases or purchase money debt, but it's otherwise very limited. In the 144A context, particularly if it's a larger company, if it's a project but more of an operating type, a real operating type business, you might have an incurrence test or a rating agency test. So you can go out and incur additional debt so long as you meet an incurrence test, basically a ratio after giving effect to the incurrence of the debt, or you get a ratings affirmation. Similar concept on expansion. Capital expenditures, these refer to you have a project in the bank 4.2 context, that's limited to the project. They're expecting that the project will not change without their consent. If you're doing a bond deal where terms may go out 20 years, over that 20-year period, you may really want to expand out or build some other type of expansion facility on the project. Your documents should be designed for that. So you might see a rating agency affirmation or an independent engineer certification associated with that. Budget delivery, another significant one in the bank context or the 4.2 context. They often expect, although the market may be loosening up a little bit on this, but they expect at least delivery of a budget. They also expect some type of at least loose compliance with a budget, even if it's an obligation to use commercially reasonable efforts to comply with the budget, and there are still some lenders that require budget compliance. In the 144A context, you may not even have a covenant to deliver a budget, and if you deliver it, you might not typically have a covenant that says you have to have a firm obligation to comply with it, because the question will be, well, what if you don't? Who are you going to talk to in that context? Amendments to material project documents, similar concept. Events of default also follow a very similar train. Events of default in bank deals and 4.2 contexts are stricter than what you would find, including, people are surprised about this, but payment defaults. You may have, we've seen transactions with a 15-day cure period, or in some cases there might be a 30-day cure period on a payment default in a 144A context, that would be very, very unusual in a bank context where the cure period might be 3 to 5 days on interest. So again, another significant difference. The ability, if there's a material project contract that goes into default, that often leads to a default under the credit agreement. That often does not lead to a default in the 144A context unless it could reasonably be expected to result in a material adverse effect, which is a standard that people often use to mitigate risk and provide some flexibility to issuers in 144A transactions. Finally, I'll just touch on prepayments and redemptions. The differences here are that in a bank transaction, you typically have the option to prepay without a penalty. Again, there's always exceptions, and in the leverage finance context, and if you want to call it the energy leverage finance context, there might be no-call provisions. But in general, in a regular project finance bank transaction, there is typically the ability to prepay without penalty. In the private placement world and the 144A world, you are typically not permitted to redeem the notes unless you pay a make-whole. And there may be transactions where during a certain period of time you're not permitted to redeem the notes at all within the first year or two. And then after that, a make-whole would be applicable. There's also, folks use the term project bonds. It can cover a wide range of markets. I've heard folks refer to an infrastructure market for project bonds, which is essentially, it's not a single standalone project. It might be a company that owns multiple projects, or it might be an infrastructure type project, a road, which is more of a real operating business, an airport. In those contexts, you might see more high yield type provisions, such as an equity clause type provision, which allows some permission to redeem the notes with proceeds of equity. So there's not a hard and fast rule. There's just norms, and what you do is you set out a lot of precedents, and you sort of look at the precedents that are most applicable to the transaction that you're doing. Mandatory prepayment events in a bank and 4-2 context include the usual asset sales, casualty events, significant contract events such as termination of contracts or payment of liquidated damages. In the institutional investor context, or the 144A context, they're not really interested in being prepaid from asset sale proceeds necessarily. They would, however, like the option to consider being prepaid. So what you often find are there are optional redemption provisions set at certain thresholds. So with that, I'm going to turn it over to Tricia to talk a bit about standard collateral arrangements.
So I'm going to talk about collateral, which as a general rule I would say is not, your collateral package really isn't going to be significantly different in a project bond deal than it would be in a regular commercial bank or a Term B project financing. As a general rule, you're going to be taking a security interest in all assets of the project, subject to certain exclusions. I think the key difference in a bond deal is along the lines of what Rob described on covenants and reps, in that you need to be very cognizant of the fact that you might need a little more flexibility in terms of kind of situations where there's a bump in the road or a hiccup that's not, significantly material, and the borrower needs to make adjustments to continue to operate its business and proceed with the project, and you may not really have the luxury of wanting to go out for a consent to your bondholder. So that's really kind of where the rub is. So whereas in a commercial bank financing, for instance, to use something that Rob was kind of going along the lines with the budget, where you might cap the amount of cash that can come out of the waterfall, which I'll get to in a minute, by a certain percentage above the budget, you're probably less likely to see that in a bond deal, because it's frankly not in anybody's interest for the borrower not to be paying its operating expenses in the ordinary course until a decision has been made to elect to use remedies. In any event, I'm gonna go through this relatively quickly because it is kind of basic in nature, but we wanted to lay it out because we know there's some people that have dialed into this that really are just more general capital markets people and may not have done much in the project bond or the project finance world, and so may not have had to deal with some of the collateral issues that come up in project deals. So basically, the project property is kind of divided into three categories for purposes of how you're going to take your security interest. There's personal property, which is equipment, contracts, permits, licenses, goods, things along those lines. There's investment property, which is also personal property, but I think we kind of deal with it differently in the collateral package, and that relates to kind of your equity interest in the project company, if it has any subsidiaries, if it's a portfolio deal, the subsidiaries, and bank accounts that the project might have. And then finally, you have real property, which could be owned real property, it could be a leasehold estate, it could be easements, it could be rights of way. So the purpose of the collateral is really to provide you ultimately, the lenders and the investors, with the right to access the project and take control over operation of the project when there are problems. It gives lenders and investors a right to foreclose and exercise remedies directly against project assets, and it helps ensures on top of the lien restrictions in the covenant package that basically third parties can't get a senior claim on the project assets. So the documentation for the collateral is kind of divided up into different categories, and obviously if you're in a cross-border deal, this will be heavily influenced as well by the jurisdiction in which you are located, because the taking of collateral is really driven by the laws of the jurisdiction where the borrower is or the real property or assets are located. So in the general buckets here are that you'll have a security or pledge agreement that covers the personal property. You'll have account or depository agreements which cover the bank accounts and the cash flow of the project. You'll have mortgages that deal with real property interests, and you'll have what are called direct agreements or consents to assignment, which, while not creating the security interest per se in a contract, provide lenders and investors with direct rights against project contract counterparties. Those are very customary in the United States and in some jurisdictions. I was told yesterday that in some other jurisdictions they're less customary, but in any event, in most of the deals I've done, that they're fairly important. In terms of the security and the pledge agreement, and you're taking a security interest in the personal property of your project, generally, again, the starting point is you're taking a security interest in all the assets, because what you want to be able to do if there are problems is to step in and take over the project and run the project, whether you do that through a foreclosure of the equity or the assets on an asset-by-asset basis. Increasingly, what we find is that there are assets that end up getting excluded from the definition of the collateral, and this is things that either are not worth the trouble that you'll have to go through to actually protect the security interest, or frankly a security interest in them is prohibited in some sort, and it isn't in anybody's interest to kind of violate that prohibition. And examples of this would be, for instance, if you have a non-wholly owned subsidiary, it may be that the joint venture prohibits a security interest in the equity, all the equity interests of that subsidiary. There may be other excluded subsidiaries that for tax reasons, if they're foreign subs and you've got a U.S. domestic borrower, that you may not take a security interest in. Permits, contracts, and licenses, leases, similar agreements. This can be, you have to be very careful about this in a project deal, because generally you'll have a definition in excluded collateral that if by their terms assignment is prohibited, unless it's overridden by some provisions in the UCC, that they're not subject to the grant of security interest. And that is, on its face, a very reasonable position for a borrower or sponsor to take, because if an agreement says that it can't be assigned and the consequences that it could be terminated or something, nobody wants to be in the position of triggering those consequences. But obviously, if it's a fundamental piece of the business, like your power purchase agreement, that's going to have to get addressed, and that would obviously, hopefully, have come up in the diligence process and be dealt with through whatever amendments were necessary in the power purchase agreement to allow for the actual assignment.
Yeah, we often, just on that point, because it is a point to be a little bit careful on, permits, very commonplace That's the nature of permits. They typically can't be assigned. However, you find a lot of sponsors who will take the initial position, as Tricia said, to just put agreements into excluded collateral agreements that cannot be assigned. If it's one thing if you're very comfortable with the diligence that you've done on a particular asset, if it's a project that's got one significant contract or two of them, and you've confirmed that that contract is assignable, that's one thing. It's another thing if you're working on a larger business and some contracts are not entirely clear whether they're assignable or not. You might get them inadvertently picked up in that clause. So sometimes we tell the sponsor, look, you need to specifically point out what you're referring to and what your concern is there.
Yeah, I mean, I think that there are deals where, and a little bit further on here we talk about concession agreements. There are often agreements with, for instance, a governmental entity that have really strong or tough restrictions on assignability. And that's when you have the discussion. I mean, if that's what the deal is and that's what was bid on, you may very well be stuck with those limitations. How you ultimately have to get comfortable if you're going to do the deal is that you would presumably do an equity foreclosure and then comply with any obligations that there were with respect to any kind of permitted transferee criteria. But again, this is heightened and should be dealt with in the diligence process so that you know that you've got a creditworthy deal in the first instance. Some other things that get carved out of the collateral, equipment that's subject to purchase money liens and capitalized leases, inevitably the documentation for those prohibits a security interest in the equipment. So generally that's kind of carved out. Accounts receivable that in certain instances, particularly for instance in power deals, you may have situations where you have energy management agreements or other types of commodity agreements where those have to be pledged in the first instance to the counterparty. Those are often carved out. And then as I mentioned, de minimis asset sales. You may also have collateral that's specific to a particular debt tranche. This is really the case, for instance, with debt service reserve. And as a lender, if you have a debt service reserve, you actually want to make sure that it's not kind of part of the general collateral pool because that really is meant to service that particular tranche of debt as opposed to be generally available. A related point that comes up in negotiation where the deals allow for expansion debt or additional debt is whether there's any restrictions or limitations on the sizing of debt service reserves for those deals because obviously to the extent cash goes to fund a debt service reserve, it's not available for the general collateral pool. So I've had some interesting conversations with people saying, well, if we don't put a limit that it's 6 months or 12 months or 18 months of debt service, you could effectively 100% cash collateralize that other tranche of debt. So it's just something that you have to be aware of. The security agreement will also deal with certain other covenants and representations with respect to collateral. It will also set forth generally the remedy section. Now, this may tie into intercreditor arrangements, which we'll get to in a little bit. But the key point here on remedies to keep in mind is the trigger standard for when an exercise of remedies occurs. And there are a range starting with a lowercase or prospective default, in other words, an event that has occurred that could lead to an event of default, to an actual event of default, to a higher standard where perhaps it's an event of default plus a certain percentage of the lenders or investors have determined to take action. I think in a private placement, well, maybe not so much in a private placement deal, but in a project bond deal, you may see that higher standard because, again, you don't want to be in a situation where there's a relatively immaterial hiccup that perhaps, like, let's say you're 10 days late delivering your financial statements. It's not in anybody's interest for certain things that may automatically occur as a remedy event upon the occurrence of that event of default to occur. So it may be that there has to be some affirmative action taken by the investors in order to trip the remedy. Remedies include, obviously, dividend stoppers, the rights to directly go to the project counterparties and get accounts receivable, and ultimately foreclose and auction the collateral. Probably the biggest thing in collateral arrangements that differentiates projects from other financings are the account depository agreements. And this is where you hear a reference to the waterfall, the cash waterfall. And these are not the typical control agreement you see in a secured deal that's 2 or 3 pages long on an account. They are much longer agreements that really control the application of cash flow of the project. And again, That agreement in a commercial bank financing with a relationship bank group is going to look very different from the depository or waterfall agreement you're going to see in a project bond deal, or frankly, possibly even in an institutional investor deal. I mean, I've done some 4.2s where the deal really is that in the general realm of things, the sponsor is supposed to operate the business in the ordinary course, and while there is kind of a general agreement on what that waterfall should be, in other words, in what order cash should be applied to pay different expenses of the project, there's a lot more flexibility built into that, whereas in a commercial bank deal, you may only monthly be able to move amounts between accounts, and you have a lot of certifications and limits on those amounts. In the other end of the spectrum, it may be more that as a general rule, when you're making payments, you pay your operating expenses first, then your debt service reserve, then other reserves, then excess cash flow sweeps, and then distributions. And it may be that you can almost do that on any day unless you're in a default scenario, which, as a technical matter, makes one question whether there truly is a waterfall, but at least upon a default scenario, there would be.
Yeah, I think this is one of the areas really where there is a bit of a tension between the project side and the capital market side, because we project lawyers love structure. Like the more structured, and when Tricia said waterfall, maybe I was the only person that noticed it, but she had like a slight smile that cracked, because Tricia loves the waterfall agreement because it's very complicated, and it is it's a significant part of a project deal. In the 144A context, though, you really do need to be careful about how structured you make it, because what seems like a very ingenious structure with a lot of protections and a lot of mechanics as to how it works, and everybody around the table understands it. Remember that a 144A deal will go out 20 years, and nobody around the table at that point will be involved in the transaction 10 years into it. So you really have to balance out the complexity with the interest of keeping a workable, living waterfall over the course of a long project, which is not really consistent with kind of standard bank project finance principles all the time.
Yeah, a related point to that, in terms of the flexibility on how these agreements work, would also be the right to invade certain accounts, which means, as a general rule, these are structured so you've got a revenue account. All revenues go into the revenue account, and then they flow through this waterfall. So they go to pay your operating expenses, then they usually go to pay your debt service, and they go to pay your other required reserves. There may be an excess cash flow sweep. I'm not being very good at turning my pages, I apologize. And then there may be dividends. And so it may be that you're running this waterfall on any given date and there's a deficiency in funds. So if on a day you need to pay operating expenses, you don't have enough money to pay operating expenses, but there's money perhaps sitting in the major maintenance reserve account, or so even in certain instances a debt service reserve account. The document may very well provide that the borrower has the right to go and kind of invade those accounts to get that money, because again, it's a general principle that if as long as the borrower is operating in the project and the lenders and investors haven't determined that they're at a stage where they need to step in and exercise remedies, it's not in anybody's interest for there not to be cash available to pay operating costs. That will just further aggravate what is potentially already a bad situation. Some of the key issues that have to get negotiated in these agreements are the treatment of tax payments by the project, whether it's the taxpayer itself or there's a dividend. There needs to be a dividend out because it's a pass-through type entity. Payments to affiliates under agreements similar to O&M agreements or other similar agreements, and whether those are operating expenses or disguised dividends. Treatment of payments to other permitted debt. That again, particularly if you've got a deal that's going out for 20 years and you allow certain other types of debt to come in, whether it's secured or unsecured, you really need to think about how does that get paid, because it can affect, in essence, a subordination, depending on where you allow the debt to come out. Oftentimes, purchase money and cap lease debt is treated as an operating expense, which means at least for purposes of the waterfall, it's being structurally senior paid out. Now, again, there's no necessarily legal or true contractual structural subordination. So at the point where there was a big meltdown, it would be what it would be. But those are things that you need to think about a little bit. The timing of the waterfall, how often the waterfall runs, whether it's, as I said, in the loosest case, basically every day the borrower can go in and pay its bills, and it pays whatever is due on those days in accordance with kind of the list. But, on any given day, debt service is not due. So, it being only allowed to run it on a quarterly day and take certain amounts out. Another big difference in project finance deals generally is the debt service reserve requirement. Generally, you see a 6-month debt service reserve for deals. It can vary depending on the transaction, but I think that's really the market norm. There's the question of, how does it get calculated? How do you take into effect payments that might be being made under interest rate hedges? If there are amortization payments that are proposed, how does that potentially affect it? If prepayments are being made, how does that affect it? And again, as I mentioned before, whether it should be designated as collateral that's limited for a specific tranche of debt. On upfront funding of construction costs, and this would be particularly important if you were doing a 144A deal for a construction deal. These generally go into a construction account, and the question is under what terms can they come out. It may be that they have to meet kind of customary conditions that you might have to make even for an initial borrowing, or they may be some more limited universe of conditions, but that will have to be discussed. How punch list items in a construction deal get funded is also something that has to be given some thought on, and any kind of true-up or prepayment mechanic upon completion. A lot of times with project deals, one of the key metrics is the debt-to-equity ratio, which has to be satisfied as of the completion date. And depending on how the equity has flown in and how the debt has flown in, you may have to have some true-up mechanism for that, and so you have to deal with that in your waterfall. Mortgages, real property, collateral, this is up to the real estate guys to deal with as far as I'm concerned, but there's some key items here that need to be thought through, including lead time items such as title insurance and surveys. Whether you need landlord estoppel, that's a third-party issue that you need to think about, which takes us to the next topic of direct agreements, which are a big third-party lead time item as well. In some financings, they're done as more of a post-closing requirement. That's more common in an operating asset. In a new build, you're probably going to require them as a condition to close. The key with these agreements, again, this is something that is different from other secured financings out there, is that you really want some direct rights with your project counterparty. So these provide you with a specific acknowledgement of the security interest. They provide that they will make payments into the designated accounts that are subject to that account agreement or depository agreement. They may include the counterparty's agreement that they won't agree to amendments and modifications without knowing that the lenders have consented to them. The counterparty may agree to notify the lender of defaults. They may address cure and step-in rights, replacement contract rights. There may be other things that need to be specifically mentioned. One thing to keep in mind here is, as a legal matter, the direct agreement can't amend the underlying project contract in kind of other than in accordance with the terms of that project contract. And I've seen direct agreements done where the lenders wanted to address an issue that they were unhappy with in the project contract, and they kind of put a provision in the direct agreement, but the borrower wasn't, for instance, necessarily signing the direct agreement, or after the fact the counterparty took the position that even though it was in the direct agreement, it couldn't really be an amendment of the underlying contract, and there was kind of a conflict situation. So you need to give a little bit of thought to that as well. So as Bob mentioned a while ago, I think one of the big issues that can come up in project bond deals, assuming it's not a single tranche deal, are intercreditor issues. And Rob will probably interject shortly and say that this is also one of the things where I have a smile on my face about, because I find them very interesting. Intercreditor issues can include subordination, thank you, and as well as exercise of remedies and voting rights. Subordination, that's a topic for a whole other day, but you can have legal and structural subordination, you can have lien and debt subordination, and all of that needs to be addressed in your intercreditor agreements. Generally, an intercreditor agreement provides kind of for the pro rata sharing of the collateral among multiple tranches of debt and how that gets applied. It will have a waterfall that applies upon the occurrence of an event of default. it addresses the voting rights of secured creditors. So if you've got hedge counterparties, which may be the case, particularly in energy deals, there's a lot of complexity that goes into that in terms of what rights they have with respect to voting on the exercise of remedies. And then one of the big conversations you have is whether there's a tranche-by-tranche voting requirement or a single-class voting structure. And this is so dependent upon the deal and whether you represent the sponsor or the lenders on what your view is going to be on this and how you think it will ultimately shake out. I mean, I've been involved in deals where you've got a bond alongside of a bank facility, and so in the first instance it was to exercise remedies, for the first 180 days, you needed 66 2/3 of the banks and none of the bond investors, for instance. And then it kind of changes over time to give the bond investors greater rights. That was customized to that particular deal. But there's a lot of structuring that can go on here. And, of course, again, it's driven by the complexity of the structure of your debt and how many layers you have, how comfortable you are with the ability, again, going back to what we've been talking about continuously, to kind of keep the project going without having to go out and get hung up with a bondholder consent or something along those lines.
And keeping in mind that, as we said at the outset, when you're going to the bond market, what you're going to then is a disclosure document that describes all of this.
Exactly.
And the more complicated the arrangements are, the more difficult it is to explain the deal initially to the rating agencies, because that's a key gating item, but then to your market. And the investors the QIB investors traditionally in the 144A market don't want to get too involved in the details. So again, if you have a very, very complex project financing with multiple creditors, multiple layers, it may not be right for a 144A project bond placement. Because you got to describe all this, explain it all, and be able to make sure that the investors understand it.
But I think, again, and that's all true, but going back to kind of why these get structured the way they do, including with respect to hedge counterparties, is not all creditors will view, for instance, a workout in the same way, right? Some people just want to get out of the deal as quickly as possible, whereas, for instance, commercial banks or perhaps more the 4-2 market are more willing to sit there and work on things and structure a forbearance agreement as opposed to kind of bondholders that will trade out or hedge counterparties who frankly don't have liquidity and whose exposure can be growing over time. So you really need to sit there and think about the competing interests, and if you're the sponsor, you need to figure out where you want to be. If you're the lenders, you need to think about how those other players might be acting and kind of how you're best situated in that scenario. And all of this, again, is, what the lawyers get paid for is thinking about what the worst case is when there's a total meltdown and how things are going to play out. So I'm going to turn it back to Rob on local law approvals and requirements.
Yeah, and I'm actually going to hand the clicker to Don because I'm just going to spend a minute on this and then hand it over to Don to talk about the tax aspects and close out Tricia's discussion with one practice tip. It is not a bad idea, and we've done this in our transactions, particularly with respect to the security documents, because people tend to look at them as boilerplate type documents and not realize that in a 144A context, you could have pitfalls in there which are unintended. So we've, in the past, scrubbed our documents at the end of the deal to look for all those places which refer to the collateral agent having some type of discretion, something as simple as you can replace the debt service reserve with a letter of credit, and it says in form and substance satisfactory to the collateral agent. There's nobody around in a 144A transaction to give the collateral agent that direction. So you look for all those pitfalls. Anyway, 1 minute on local law approvals and requirements. Really the point here is just that for every jurisdiction that you're doing a deal in, and that's including where a project may be located or where the issuer may be located, you have to consider all of the requirements that you would otherwise consider in a U.S. transaction: disclosure requirements, issuance requirements, requirements relating to collateral, things as simple as concepts with respect to collateral of creation, perfection, and priority. All of those obviously could be different on a jurisdiction-by-jurisdiction basis, and the timing of a transaction could be affected by that. You may need to have documents submitted to a local agency in a certain period of time so that the securities can be issued in another period of time. So all of those requirements have to be factored into your transaction process. So I'm going to turn it over to Don to touch a little bit on the tax aspect.
Yeah, and perhaps mercifully, we've dedicated exactly one slide to tax considerations that may be relevant to project bond deals. I think what we've done here is try to identify just a handful of current or lingering issues that can merit attention in a particular transaction. And with that, perhaps no better place to start than the availability of an interest deduction for the issuer, since issuers in high tax jurisdictions like the United States and elsewhere obviously will consider of great importance the ability to deduct the interest on whatever debt they're going to be issuing. Now, here in the United States and elsewhere, there are important limitations that can arise on the ability to deduct interest, statutory or otherwise, and so focusing on the ability to deduct interest is something that typically merits consideration when looking at a debt issuance such as a project bond. The first thing we identify here is just the obvious relevance from a common law standpoint in terms of whether what we're issuing really can be respected as debt from a tax standpoint, or whether it alternatively could be characterized as equity, or perhaps even just an interest in the underlying collateral, depending on the circumstances. From the tax side, the form of the transaction, the fact that we're purporting to issue bonds, doesn't really control. And what the tax law in the United States would say is that we got to look at all the facts and circumstances that are relevant to the particular issuance and decide based upon those facts and circumstances what the thing really should be considered. In this case, the type of things that can come into play are, the maturity. Is the maturity too long? What's the extent of subordination of the debt? What's the capitalization of the issuer? Is it too thinly capitalized? Those type of considerations can come into play in evaluating whether or not we can properly conclude that the instrument is debt from a tax standpoint or should be treated in some other manner. And
particularly, Don, in a 144A context, we've seen situations where the usefulness of the 144A context, or it is used often with assets that have long life, very fixed contract payments, so it gets a lot of leverage. So it may be the case that a sponsor is looking to really, lever up as close as possible to 100%, and that then puts pressure on the analysis as well.
I would also think it would put pressure if you were doing a construction financing and you were allowing the equity to be back-ended. So if you were pre-funding all the construction costs with the project bond with the equity coming in after the debt had been used up, presumably that would be an issue for you on the...
No, absolutely. All those type of things will come into play, particularly in the project context, because you're essentially financing the underlying asset, and to the extent that basically everything that comes out of the asset is being used to service debt, right. You start to sit there and wonder, are you really just a lender, or are you buying the underlying asset? And that's perfect, completely relevant from a tax side. So then once you get beyond that sort of common law analysis in terms of whether what you're buying is really debt, you then are faced with potential statutory limitations that have evolved under U.S. tax law and can also come up in foreign tax law as well. A couple we identify here is the high yield bond limitation. And this is something that emerged from the sort of Charlie Sheen Wall Street days, where junk bond is popular, and Congress became concerned about people financing on a non-current cash paid basis by issuing discount debt or PIK bonds where the lenders weren't going to get paid until some late time in the future. Basically the decision made was that was looking sufficiently equity-like that the availability of the interest deduction was going to be either limited or completely denied. And the standard there under the U.S. tax rules is that if you're issuing debt on a deferred interest basis where the interest rate exceeds the monthly published quote-unquote AFR by the IRS by more than 5%, then your interest is going to be deferred, and to the extent it exceeds that AFR rate by more than 6%, the excess over 6% is just completely disallowed. Now, the AFR rate is essentially an extrapolation of Treasuries. So, in our current interest rate environment, when you're looking at 5 or 6% of AFR, it's not a very high rate. So, the ability, at least in today's rates, to issue something on an interest deferred basis can be particularly limited if you are looking to get a current interest deduction. And one thing to note here is that this rule generally applies only to debt that has a term of more than 5 years and where the interest is deferred more than 5 years. So one possible fix, if you find yourself with a debt instrument that potentially is subject to this high yield limitation, is to essentially provide that the interest has to be caught up and currently paid by the time of the 5th anniversary, in which case you can sort of avoid the potential limitation. Another statutory limitation under U.S. rules is one where there's a related party guarantee from a foreign parent or another party that is not essentially a U.S. taxpayer. And in that circumstance, this is essentially the U.S. saying, we're not going to allow you to issue debt as a way to skinny down your U.S. tax base and take earnings out of the United States on a tax-deferred basis. So this rule would say that interest can only be used to offset 50% of the taxable income of a U.S. issuer, and any additional interest over and above that is essentially deferred and gets carried forward to future years subject to the same limitation. This related party rule generally kicks in if the debt equity ratio of the issuer exceeds 1.5 to 1, and so it's essentially the United States thin cap rule, and obviously other jurisdictions have similar thin cap limitations with their own parameters. One final note on just the topic of interest deductions is that there are a complex set of Treasury regulations that deal with situations where bonds are issued with various types of contingent payments. And if those contingent payments are such that it makes it hard to determine what your actual yield is going to be on the debt instrument, what these rules essentially say is that you have to essentially invent a yield based on what you think the likely outcome is of the debt instrument, accrue interest at that invented yield, and then adjust accordingly as time goes on and you figure out what the actual payments are. Now, this type of instrument can be unattractive from the standpoint of a holder because they may end up accruing, in effect, phantom income in the early years of a debt instrument while the contingencies are being resolved. But from an issuer standpoint, it can sometimes be attractive because it presents them the possibility of accelerating deductions based upon anticipating contingencies down the road. The next topic we identified here from the tax side is withholding taxes, both U.S. and non-U.S. Now, in the United States, we have a statutory withholding tax rate of 30%, but at the same time, we provide a fairly broad exemption for so-called portfolio interest, with the main requirement from a bond issuance standpoint being that foreign holders are required to certify to the issuer as to their non-U.S. status in order to claim entitlement to the exemption. Beyond that, if there are circumstances where the portfolio interest isn't available, the U.S. does have a broad range of tax treaties that provide exemptions from withholding on interest or alternatively may provide for a reduced rate. Moving outside the United States, different jurisdictions have different rules in terms of how they tax interest. Latin America in particular tends to impose withholding taxes on interest, and so in jurisdictions where you see that, what is customary is that there would be a gross up payable by the issuer to holders so that they essentially receive their interest in an amount that basically compensates them for the withholding tax that's incurred in the jurisdiction of residence of the issuer. Because of the withholding tax risk that can arise in foreign jurisdictions, what has been customary for the issuer is that the issuer would look for tax protection through a redemption feature, where in the event that a change in tax law arises where either a withholding tax is going to be imposed or the rate of withholding is going to be increased, they would have the right to call the bonds for redemption essentially at par, assuming that there's no way for them to avoid that withholding tax. Just one final point we were noting here on withholding taxes is that in the United States, I'm sure most are aware that we do have these new FATCA rules that are going to be coming to effect. As of right now, they're proposed to become effective next year. Under those rules, basically foreign financial institutions are required to register with the United States and agree to comply with various information reporting requirements with respect to U.S. account holders. If they fail to do so, there's a 30% withholding tax imposed on payments that are made to those institutions. The implication there being that if you have account holders that are holding through offshore accounts and their relevant financial institutions don't agree to comply with these FATCA requirements, this withholding tax is going to be incurred. The current market practice here seems to be that because this is a tax that can be avoided by the financial institutions by agreeing to comply with these IRS reporting requirements, the withholding tax is not going to be for the account of the issuer, and therefore a gross-up generally would not be available. Given the time, I'm just going to skip quickly to the bottom of the page and discuss briefly guarantees and pledges, because it sort of goes back to something that Tricia had mentioned earlier in terms of collateral packages. With respect to a U.S. issuer, something that often arises is that they can have foreign subsidiaries, and under our quote-unquote CFC rules, if a CFC, foreign subsidiary of a U.S. issuer, provides credit support for an issuance by the U.S. issuer, that credit support can essentially be viewed as a dividend from that foreign subsidiary up to the full amount of the debt for which the credit support is being provided. So that is a potentially nasty tax consequence that U.S. issuers seek to avoid. That credit support that is essentially prohibited under this rule includes both guarantees by the foreign sub as well as pledges of the assets of the foreign sub or of its stock. The only exception that's been provided through regulations is that the regulations will allow for a pledge of no more than 2/3 of the stock of a CFC foreign subsidiary. And so the market practice generally is that a collateral package will not seek to attach to assets of a foreign subsidiary, but will be limited to this sort of 2/3 pledge of the stock of the foreign subsidiary. There are potential exceptions to that if folks are comfortable that a greater pledge won't give rise to adverse tax consequences to the U.S. issuer, but general market standard is to limit it to this 2/3 pledge.
Just on the very, very quickly, because we're reaching the end of our session, just keep in mind that there are potentially other laws that could come into play in the context of a project bond offering, so-called blue sky laws, which are in the various states if you're doing a private placement. Obviously, we've already mentioned that foreign laws could be applicable if you're offering securities outside the United States. There's another law, the Investment Company Act, or sometimes referred to as the 40 Act, that needs to be analyzed to ensure that you don't run afoul of that especially if you're using a holding company structure as the issuer. And finally, other rules that I'm sure you've heard of, OFAC, FCPA, AML and money laundering rules. All of those need to be looked at, especially if you're dealing with a project located outside the United States. Also needs to be looked at even if you're working on a project in the United States. That's all I'll say on that.
Great. Thanks, Bob. That concludes our webinar. We certainly hope that folks found it useful. We'd welcome feedback, honestly, if folks or if folks have questions afterwards. As I said in the beginning of the presentation, the bios and contact details were all reachable, and we'd love to hear from you. But again, thank you very much for listening in. And one more time, if you're interested in CLE credit, there is a process for it on the screen, and if it's a little bit hard to follow, again, you can feel free to reach out to us, and we'll help you out with that. Thank you all.